Hello, everyone. Welcome to Hash It Out. I'm your host, Toya Zhang. Today with me is Rob from Clearpool. Welcome, Rob.
Hi, Toya. Thanks for having me.
Hi. Could you please just introduce yourself and your role at Clearpool for us?
Absolutely, yeah. My name's Robert Alcorn. I'm the co-founder and CEO of Clearpool. I come mainly from a traditional finance background. I worked in TradFi for about 15 years previous to founding Clearpool. So my background is kind of in capital markets, credit, and most recently in collateral trading. I was a repo trader for the last 4 years of my TradFi career before I founded Clearpool, which was earlier on last year in 2021.
Yeah. Could you just introduce our audience, because not everyone is familiar with Clearpool? How does it work, like as a platform?
Yeah, so Clearpool is it's a decentralized marketplace for uncollateralized liquidity for institutions. So that's quite a big mouthful. So to break that down, we kind of focus more on this marketplace element. I think a lot of your viewers, your listeners, will be familiar with protocols like Aave and Compound. So they are marketplaces as well, but they're marketplaces for assets. You can borrow and lend assets there. If you want to borrow, you have to be providing collateral, and this means that it can be done anonymously. On Clearpool, it's a marketplace, but it's a marketplace for borrowers. So when you connect to the Clearpool app, you don't see a list of assets, you see a list of borrowers. And those borrowers are actually borrowing without collateral, so uncollateralized or unsecured. So they're kind of relying on their credit reputation for that. And because of that, obviously there's more risk involved. There's counterparty risk here. So those borrowers are paying much higher interest rates for stablecoin liquidity than what you would see, on the likes of Aave and Compound. Effectively, what we have is single borrower pools. So each of those borrowers has their own liquidity pool. They have to go through like an onboarding process before they can launch the pool. Once they've done that and the pool is launched, anybody can connect to the app and see those pools and make a decision on who they want to lend to. So, as long as you have, a Web3 wallet, then you'll be able to connect, see the borrowers, and make a decision on who you want to lend to. The pools are dynamic. So when you provide liquidity, there's no lockup. You can withdraw at any time. This is obviously, very, very attractive, especially, in times like we're in right now, following the collapse of FTX, a lot of volatility in the market. So to have that ability to be able to withdraw whenever you want is very attractive to lenders. But they're also very flexible for borrowers as well. So borrowers can draw down liquidity whenever they want. They can repay whenever they want. And they pay interest, whenever they want. There's no set dates, for the repayment of principal or interest. And the borrowers, because they control their own pool, they can control, the amount of borrowing, the interest rate that they pay through a very unique interest rate mechanism that we have within the pools. But they also have this ability to kind of build a credit reputation, a credit profile within DeFi, because they have their own pool. On other protocols, they kind of group together. So you have multi-borrower pools. Doesn't give them that ability, to control the size, to control the interest rate, but also build that credit profile. The flexibility is there for borrowers as well. And then finally, on the interest rate model that we have, this also compensates lenders when liquidity risk increases. So if the borrower starts to draw down more liquidity from the pool, there's less liquidity available for lenders to withdraw, but the interest rate will go up. So the higher the utilization, the higher the interest rate. This compensates the lenders that are in the pool, with higher interest rates when that liquidity risk increases. And again, that's something, that's very important, especially during times like now, because that means that you're getting a risk adjusted return. And if you are locked into a pool, then you're getting compensated with higher interest rates. That's kind of Clearpool in a nutshell.
Yeah, I think there are a lot of details that we can dive, but probably not going to be covered during this interview. Offline, I'm going to have a lot of questions, but a very generic question. It sounds very counterintuitive, for people who are in this space, that like reputation or credit is factoring in the lending and borrowing, like DeFi space. It's supposed to be kind of the code is the rule, the law, and anonymity is kind of what we claim for in this space. So what give you the idea of having such a platform where like reputable borrowers are being exclusive clients?
Yeah, that's a great question. So the problem that we were looking to solve when we thought about Clearpool was over collateralization. So this was actually becoming, a major pain point for a lot of institutional borrowers in DeFi. So as I mentioned earlier, if you go to one of the over collateralized protocols like Compound and Aave, if you want to borrow, let's say, $1 million, you probably have to provide, at least $2 million of collateral. So if you want to borrow $1 million in stablecoin, you might have to provide $2 million worth of Bitcoin, for example, in order to be able to borrow. So that's actually a very inefficient use of capital, especially for institutions. So we noticed that there were many institutions that were suffering, with this problem, and the demand for unsecured liquidity was growing. And many of these institutions, are in the open, and they're happy to be public and to use their reputation in order to be able to borrow without collateral. So whilst they're paying much higher interest rates, the collateral can be used elsewhere, and that allows them, to then be able to pay those high rates. And as we've seen, there are a number of lenders, LPs in the ecosystem, that are willing to take on that credit risk of these type of borrowers. This is essentially, risk return. So lenders are aware that there's no collateral, that there's the risk that the borrower may default, but they deem the interest rates, the high interest rates they receive, to be compensating them, for taking on that risk. So that was really the problem that we were looking to solve. And that kind of answers your question. But I think, an important thing to touch on there as well is that we didn't want to just solve that problem for borrowers. We wanted to make sure that we built a protocol that was giving lenders the opportunity and the ability to manage their risk, and to hedge risk, and monitor risk in real time. And that's what Clearpool is all about. So going back to, the single borrower pool concept, the flexibility of being able to withdraw whenever you want, and then a bunch of other products actually that we're building now, which will give lenders, even more ability to manage and hedge risk going forward.
Understand. So in terms of this market size of market makers or reputable like institutions, their borrowing in size, how big are we talking about?
So we do have mainly sort of crypto native market makers, high frequency traders. These are the main borrowers that are in this space right now. Of course, they're very familiar with this space. This is where they operate. So that was where the sort of initial demand was. The pools on Clearpool have varied in size, since we launched in March earlier this year. So I think at the height, we got up to around about sort of $170 million total liquidity provided on the platform. I think we had 9 borrowers at the time, and the pools ranged, between sort of, as small as $3 million in total size, and as large as maybe like $15 to $20 million. So it really depends on, the size of the borrower, their credit worthiness, and the appetite, of lenders, to lend to those borrowers. I think now, we definitely see more interest from different borrower profiles. So, within the crypto ecosystem, there's interest from the likes of miners, for example, other crypto projects, even exchanges and DAOs. We're having those sort of conversations, within the crypto ecosystem. But I think Clearpool is also very attractive, to sort of non-crypto native institutions. So we think, in the future, we'll see, a number of different borrower profiles come into this space. But in the beginning, it's kind of been more focused on the market makers and the trading companies.
Is it hard to convince them on board? Well, what are the challenges?
Well, I think, of course, again, those borrowers that we have right now are very familiar with this space, very comfortable operating in DeFi. There are, a number of sort of more traditional institutions that have different types of risk concerns and requirements. They don't fully understand sort of smart contract risk, for example, or they might come from an environment, where they're regulated, or they have higher compliance requirements. So actually, one thing that we've done there is we've created what we call at the moment permissioned pools. So everything that we spoke about up till now was permissionless pools. So basically, that means that anybody can be a lender, the borrowers or institutions. In the permission pools, we have institutional borrowers and institutional lenders, and they've all gone through the KYC process. Mm-hmm. So this gives those types of institutions access, to DeFi lending and borrowing, with that sort of fully KYC compliant access. So we've seen, a lot of interest from sort of more traditional financial institutions getting into this space using those products. So we launched a pool earlier this year for James Street, for example, is quite a large Wall Street institution. They were borrowing from Block Tower. And what we're actually doing here is building a more sophisticated version of that product. So up to now, those loans have kind of been structured, bilaterally between borrower and lender, and they're kind of using Clearpool as a settlement layer. We're actually building a more sophisticated version of that product, which will probably launch early in the new year. And this will allow, these types of institutions with those, higher compliance requirements or regulatory requirements to be able to operate in this space comfortably, knowing that everybody has gone through the same KYC, KYB, ALM process. So yeah, it's a new product, and it's very exciting to see, a lot of interest from the larger institutions in this space.
Yeah. Is there any I don't know how like this whole FTX fallout is impacting the institutions like trader space. Is there any kind of extra layer of risk management implemented on Clearpool after this, or you've seen any risks there?
So from the institutions, most of them, will perform their own credit analysis. So, they will see, all of the other institutions that are operating in that permissioned environment, and they will be able to then go and perform their own due diligence, their own, risk analysis. On the permissionless pools, right now we have partnered with a project called Credora. Credora basically is a third-party platform that provides credit scoring for the borrowers in the permissionless pools. So it's a requirement for them to go to Credora and get their credit rating from Credora, and to perform, some KYC and onboarding over there as well before they can launch a pool on Clearpool. Right. So this means that, lenders in those pools know that the borrowers have been able to go through that process. They can see the credit rating from Credora, and they can see if that changes. It does update in real time. And this obviously gives lenders a lot more information, which helps them in their decision-making process. Yeah.
In this space, it's never-ending improvement. You don't know, like since
Yeah.
one incident, what do you need to implement next?
Yeah, it's you know it's always changing, and I think that is a part of this market that will also evolve a lot over time. The ability to be able to to give a credit rating on chain, based on chain activity, through things like zero knowledge and cryptography, to be able to sort of like take all the data that is generated through this on-chain activity and use that to provide a real-time credit score. I think there's huge opportunities in that space, and that's something that we'll see evolve over time as well.
Yeah. Clearpool also has the token. How does the token being utilized across the platform?
Yeah, so Clearpool has quite a lot of utility within the protocol. So borrowers, have to be staking Clearpool right now before they can launch a pool. So there's a calculation for the amount that they would have to stake, and that gets kind of locked up for the duration of the pool. And the duration of the pool is effectively perpetual. There's no maturity for these pools, so they can sort of remain open, for long periods, even if the borrowers aren't active. If they've repaid, they will usually leave the pool open so that they can start to borrow again in the future. So we have the borrower staking, which locks tokens up for a long period of time. We also have now what we call Clearpool oracles. So Clearpool oracles are institutions who basically they provide the inputs that price the interest rate curves for the permissionless pools. Now, by doing that, they also have to be staking a minimum amount of Clearpool themselves, but then anybody else can then stake their own Clearpool to an Oracle staking pool. And oracles get rewarded when the parameters that they provide fall within a certain distribution. And when those rewards come from emissions, and if you're staking to those oracles that are successful, you will also share in those emissions. Oracles take a small fee of that. So this really kind of secures that pricing mechanism. So the stakers will be staking to the most successful oracles. That incentivizes the oracles, to give accurate and reflective pricing for current interest rates. So this ensures that the interest rates that are paid and received in the permissionless pools also move with the market. So if interest rates are moving up in the market, this will get reflected through that process. So the interest rates are constantly moving with the market. So that's another utility for Clearpool, and of course you can stake Clearpool there. We also have a buyback mechanism. So Clearpool's protocol revenue is generated in stable coins, or in the asset of the pools, which at the moment is USDC. And we take that revenue once per quarter and we use it to buy back Clearpool. At the moment, all of the buybacks are being burned, but later on, we'll take a percentage of the buyback and also use that to replenish the reward pools so that we can sustain the staking rewards over time. So they're the kind of like the main utilities for Clearpool. But we're introducing a lot of the products next year, which will further enhance the utility for Clearpool and the ability for the protocol to generate more revenue as well through fees.
Yeah, actually, this is a trend that we are observing as well. A lot of the DeFi projects are actually reviewing their formula of the curve, just trying to refine it, because they noticed that like the previous kind of high yield or is not sustainable for a long tail kind of customers, and also the protocol token, the utility of them needs to be refined as well. So this is what we observe, and we're going to see a lot of changes in 2023 if they can implement it in time. So what's next for Clearpool? Is there any kind of next milestone that you would like to achieve soon?
Yeah, so I think the next sort of major product launch will be the permissioned pools that I was talking about. So the permissioned product, it's actually going to be called something else. We've kind of rebranded. And this obviously will be focused mainly on institutions, but all of the revenue that's generated through that will also, come into the main protocol and be used through that buyback mechanism. So that will benefit all SQL holders. So that will be the first thing to come. Beyond that, we're working on a number of products. So right now, I mentioned that you have the ability to withdraw liquidity at any time, from the pools. We're actually going to be introducing a product called term pools, which means that you'll be able to select a time period to lock up your liquidity within the pool and receive a higher interest rate for that. So obviously borrowers also have demand, for term liquidity. So this will give the borrowers, kind of guaranteed term liquidity and give lenders the ability to lock liquidity up and receive a higher interest rate for that. On the back of that, we'll then be able to build like a term structure of interest rates, which will allow us to then also build more structured products on top of Clearpool. Clearpool is very composable. So it allows, for this innovation to be built on top of the sort of the core protocol which we've already built. We're also going to be introducing a product which will allow lenders to diversify across all of the pools in a single transaction. So what we see right now from the on-chain data is that many lenders are lending to all of the borrowers, or most of the borrowers. So that at the moment will require a single transaction for each pool. So to make that process more efficient, they'll be able to do that in a single transaction through this diversified pool. But then we'll also have a secondary market where you can trade the tokens that you receive when you are lending into any of these products. So when you lend into the pools at the moment, you receive what is called a CP token. So this is very similar to the C token you get from Compound, for example. It represents the liquidity that you've provided to the pool, and it accrues the interest rate, and it also represents the credit profile of that pool's borrower. So these are pool-specific tokens, and you'll be able to trade them on a secondary market. Same thing for the term pools. If you've locked up your liquidity, but then you want to get it out, you'll be able to trade that token on a secondary market. And the same thing for the diversified pools as well. If there'll be a secondary market, so you may be able to sell those tokens at a higher value than the NAV, for example. So all of this will give, as I mentioned earlier, give lenders the ability, to manage risk, more efficiently. So they're kind of like the sort of the major products that we're working on right now. There's a bunch of other sort of improvements coming. We're improving, the dashboard for staking. We're making a few other changes, to the UI UX. But overall, next year, I think the focus is really going to be on those products and the secondary trading of all of that, which will give lenders the ability to manage and hedge risk. And I think this is really important because a lot of the institutional lenders, that want to get into this space, because they see that arbitrage opportunity with the high yields, they need to have the ability to do that. They have risk management teams, and they have to stay within certain mandates, and they'll need to see that sort of sophistication on the product side, to be able to actually participate in this space. So I think that the introduction of those products will, really enhance the product ecosystem and attract more and more lenders and borrowers into this space.
Understand. It sounds this is maybe far off. It's my personal question. Like, it sounds like the platform is very ripe if you want to build an OTC market of let's say any structured products between institutions. Is it ever be in the roadmap thinking of that?
Yeah, I mean, so as I mentioned, it's very composable. So we already have, other protocols that are building things on top of Clearpool. One of them that is launched is Idle Finance. So they have tranching on a couple of the pools. So you can, if you want to take on less risk, you can go into a senior tranche and get slightly lower interest, but have that sort of like first loss capital protection. Or you can go into the junior tranche and get even more, even more yield. So tranching is already something that has been built on top of Clearpool by by another protocol. As I mentioned, we're building a lot of things ourselves, and then those products will then, introduce, even more opportunity to innovate, so the diversified pools, will be like an index. The first pool will be like an index. So you're basically tracking the Clearpool index by investing in that pool. That will then lead, us to be able to launch an index swap. So again, you're hedging out interest rate risk. The secondary trading market will allow us to introduce leveraged lending, so like a repo market. So you'll be able to sort of, lend into the pools and then take those tokens and lend them somewhere else, and then get leverage. And then we'll also be looking on the back of that to introduce things like credit derivatives. So there's tons of things that can be done. That's the beauty of Clearpool is it is so composable. The possibilities are kind of limitless in a way.
Yeah, I think by hearing the story, we have already got a sneak peek of how rich financially the DeFi space could be, and what we are experiencing now as just the basic curve of lending pool at this moment is just only the foundation of it. It's quite exciting to see what's going to be built in 2023. It doesn't matter if the market needs to recover for a year, and then people will build. Probably we'll see more products in 2024 then.
Exactly. It's a great opportunity, to build, right? I think everyone always says that in a bear market. I think this is the mother of all bear markets now, with what has happened. And, I think it's probably set the industry back, a couple of years or so. And, you can look at that, negatively, but we prefer to take the positives out of this. Clearpool has performed, extremely well through all of this volatility this year. Protocol has effectively been stress tested throughout this with the Terra Luna event, and the 3 Arrows, Celsius, Voyager. We had the Wintermute hack. Wintermute was a borrower on Clearpool at the time and still is. And now, of course, the FTX. So, the protocol has performed really well through all of that. Lenders have been able to withdraw liquidity, which I think is very important. Any lenders that are remaining, on the protocol are getting compensated with higher rates. And, it like with most other DeFi protocols, it hasn't broken, it works. And, we're really taking the positives out of that, but also, looking at this as an opportunity, to build the products, that we mentioned. We're in a very enviable position. We have plenty of runway. We weren't exposed to FTX in any way. And we have a very sort of close-knit team, which is really focused on a product side, because we know, it's difficult because, of course, a lot of investors in the token obviously want to get, immediate returns. But I think, if you sort of zoom out and look at the bigger picture and look at where Clearpool is going, if you can sort of be aligned with our long-term vision, then, I think, we're going to be very well positioned to be, one of the strongest protocols that comes out of this.
Yeah, thank you very much. After this fallout, people are saying, starting to realize how undervalued DeFi products are. Do you have any final words for our audience?
Yeah, I think, I sent a tweet this morning. I think that it's very important right now not to focus on things like TVL. This is always something that I think has been kind of like a barometer of success for DeFi protocols, but it's a bit of a misconception. So I think, if anything, a higher TVL right now would imply a higher risk, especially in the uncollateralized space. So I think, this, just to repeat myself, it's just as a good time to zoom out and take stock of what has happened. What is working. Like I mentioned on Clearpool, lenders have been able to withdraw, and I think that's a really, really important thing that people need to understand, because the last thing you want to be is during this sort of period of volatility, you don't want to be locked into a loan at a fixed rate, that was fixed, 1 or 2 months ago when volatility was much lower. You want to have that ability to be able to withdraw. You want to be getting higher interest rates, risk-adjusted interest rates, that are driven by a market process. So I would just, focus on the fundamentals. Try and figure out what is working. What has worked well through this, the volatility that we've seen this year and especially recently, and focus on that. And I think just having that that patience to be able to sit through this. And I think definitely DeFi is on the right track. It's only going to become more prominent as the comparisons to the problems of CeFi are continue to be made. I think the future for DeFi is looking very good right now.
Yeah, thank you very much. Thank you for joining me, Rob.
My pleasure. Thank you for having me.
Yeah.